Welcome back to The Deep Dive, where we break down market intelligence into the key strategic insights you need to know.
Today we are digging into a really interesting one. It's the Q3 2025 earnings call for Mondelz International, ticker MDLZ. The call was on October 28th.
And cautious is probably the word of the day here.
Cautious is definitely the headline. But what I think is so revealing about this one is that it really captures this huge inflection point for the whole consumer staples sector.
How so?
Well, you see Mondelz caught between these two sort of crushing forces. On one hand, they're dealing with the highest commodity costs in years. We're talking cocoa specifically.
Right.
And on the other hand, they're seeing consumers finally hit their breaking point on price.
It's that classic squeeze, and the market saw it immediately. Okay, let's unpack the snapshot of the results. Because on the face of it, it wasn't a total disaster.
No, not at all. Revenue was $9.74 billion, which is a pretty respectable 5.9% year-over-year increase.
Yeah, their adjusted EPS came in at $0.73. That actually beat expectations by about 2 cents. So far, so good.
It sounds fine, yeah. But that little EPS beat was completely, overshadowed by the reality underneath. The real pain was on the margin line.
The operating margin.
Exactly. It compressed, and not by a little. It dropped from 12.5% last year all the way down to 7.6% this quarter.
Wow.
And that huge drop shows you just how brutal those record cocoa prices were, which peaked right in Q3.
So the story isn't really about this quarter, it's about the forecast. That's why the stock dropped.
Precisely. Despite the EPS beat, the real takeaway was the guidance cut that came with it. The market reacted instantly, sending the shares down about 5.9% right after the call.
They were looking straight through the Q3 numbers and into a very uncertain future.
They were. And investors really focused on two things here. First, this dynamic between price versus volume.
Okay.
And second, the timeline for when they'd get any relief.
Let's start with that dynamic, the balancing act. Management did a pretty good job raising prices, right? About 8% on average.
They did, and that successfully offset a huge chunk of the inflation. But that pricing had a very real cost to the business.
They paid for it with volume.
They paid for it with volume. Their volume and mix dropped 4.6%. That drop is the smoking gun. It shows that price elasticity, how sensitive you are to a price hike bit back, way harder than they thought it would.
So they were protecting the margins on paper by charging more, but they were actually selling fewer chocolate bars.
Fewer chocolate bars, fewer biscuits, especially in developed markets.
And this whole conversation, of course, it all comes back to cocoa.
It all comes back to cocoa. Management confirmed Q3 was the absolute peak of the cost pressure for the year. And that should be the good news, right? The worst is over.
But there's a catch.
There's a big catch. This is the critical detail. While they see prices starting to moderate, they were crystal clear that the full benefit of that relief is a 2026 story.
Not a Q4 factor.
Not a Q4 factor at all. They're hedging, their inventory. It all means the P&L doesn't get a break until next year.
Which makes me wonder, if Q3 was really the peak, why did they cut their full year guidance for 2025 so much? I mean, does that suggest the demand problem is maybe worse than they're letting on?
That is the core tension, isn't it? The guidance cut was the big yellow flag. They took their organic revenue growth forecast from 5% down to about 4%.
And the bottom line adjustment was even more painful.
Much more. They took the adjusted EPS guide from being down maybe 10% to now being down approximately 15% year over year.
This is a huge change for the rest of the year.
It is. The size of that cut tells you it wasn't just a small miss. It was a realization that multiple things converged at once. They pointed to 3 specific headwinds.
Okay, what were they?
First, they said tariffs and just general consumer uncertainty, a broad drag. Second was material destocking by U.S. retailers.
Meaning stores were just ordering less to keep their own inventory down.
Exactly, to save on their own working capital. And the third one, which really shows you how local this business is, was the unprecedented summer heat wave in Europe.
Right, people just don't buy as much chocolate when it's boiling hot outside.
They really don't. It's a key volume driver for them. So those are the fires they were fighting. But the real story is how they're planning to use these lessons for 2026.
Okay, the recovery plan.
They seem pretty confident. Their roadmap is built on 2 levers. First, that cocoa price normalization we talked about. And second, they're targeting high single-digit EPS growth for 2026.
And here's the part I found interesting. They're planning to hit that target even after they make some pretty material investments back into the business.
Which is a big signal of confidence.
Let's pivot to the geographic breakdown because the problems are really different depending on where you look. We have to start with Europe. That was the epicenter of the shock.
Europe was brutal. I mean, they had to raise prices by up to 30% on chocolate in some places. Just staggering. And that hit the UK and Germany especially hard.
And their internal models just couldn't predict the reaction.
They couldn't. They were expecting elasticity of maybe 0.4 or 0.5. Instead, it shot up to 0.7, maybe 0.8.
To put that in human terms for you, they thought if they raised prices, maybe 4 out of 10 sensitive customers would leave. Instead, it was closer to 8.
Yeah. Now, management correctly pointed out that historically, given a 30% price hike, that number isn't dramatic, but it's way worse than what they had planned for.
So how do they fix it?
Their fix is all about adjusting what they call price pack architecture, or PPA.
Which is basically a fancy term for strategic shrinkflation.
It's exactly that. You reduce the 300-gram chocolate bar to 250 grams to keep the price on the shelf looking reasonable. The insight is they're sacrificing the size to protect the brand and the margin.
But that's very different from just throwing everything on sale.
Very different. And in the short term, they're leaning heavily on Christmas. Seasonal stuff has lower elasticity because people are buying gifts.
Okay, let's cross the pond to North America. A different challenge there, more about a value-seeking consumer.
Right. The U.S. biscuit market slowed down, volume was down 4%, consumer confidence is low, and that drives behavior.
And the big story there is the channel shift. People are moving away from traditional grocery stores.
A huge move. They're going to club stores like Costco, to value stores, and online. So Mondelz has to follow them.
So they're using that PPA strategy again.
Exactly, but they're adapting it. So you'll see smaller packs at lower price points, like $3, but then also huge packs designed for promotions in the club channel. You have to meet the consumer where they are.
At the same time, they're not giving up on innovation.
No, they're doubling down on premium with Tate's and also the better-for-you stuff like Perfect Bar and Builder's Bar, plus more zero-sugar Oreo and gluten-free lines.
And this gets back to that key strategic point. Management was very clear. This is not a broad value strategy.
Right. They said past promotions didn't really work. They prefer this surgical PPA approach that protects margins. They control the size, not the price.
So despite all the trouble in developed markets, the emerging markets are still the engine room.
They are. Latin America and Asia are showing real resilience. Now, the reported 4.7% volume decline looks bad, but it's super misleading.
Why is that?
It was heavily distorted by two things: hyperinflation in Argentina and a deliberate choice in India to downsize products instead of raising prices. PPA again.
So if you strip those two out,
The decline shrinks to a much more manageable 3%. You see double-digit growth in Brazil, a nice recovery in Mexico. China is still a weak spot, but they're optimistic long-term.
if we connect all this back to the big picture, we see them pulling these strategic levers that won't really pay off for a while.
Yeah, until 2026. Even 2027, they announced a big new multi-year supply chain program for North America.
This is about efficiency, automating bakeries, and optimizing their DSD, their direct store delivery system.
That DSD system is so crucial for them. It's how they control shelf space. But they're talking about using fewer distribution centers to save money. And the real impact from that won't hit until 2027.
So that's the long-term play. What's the immediate fix for volume?
Advertising, lots of it. They said SG&A, specifically media spend, will see a big step up in 2026.
And that's funded by the cocoa prices coming down.
That's the plan. Use the money they save on commodities to get people buying again. It's a very clear strategy. Regain financial flexibility, then immediately reinvest it into growth.
And you have to remember, the whole staples sector has been lagging the market. Investors are rotating into defensive plays. The Mondelz story is just stuck waiting for that commodity relief to finally hit. Okay, now let's turn to our thought experiment. The plausible but outrageous trade. And just to be clear, this is purely for intellectual fun.
Right. So given that almost 6% drop in the stock, it's clear the market is focused on one thing: the volume pain in North America and Europe right now.
They know the cocoa relief is a 2026 event, and the supply chain efficiencies are even further out in 2027.
So the idea here is to play that timing gap. You could implement a near-term short strategy, betting on that elasticity, pressure, and skepticism to continue through Q4 and into early 2026.
So you're betting that the market will stay pessimistic until they see real hard evidence that the cocoa moderation is happening and the volume is turning around.
Exactly. And now for the outrageous part. At the same time, you'd open a longer-dated, leveraged long position, maybe using something like APS, those long-term options that mature deep into 2027.
So you're not just shorting, you're making a deliberate bet on the future recovery.
You're betting on that high single-digit EPS growth coming back, fueled by all that ad spending in 2026, and the DSD optimization finally hitting the P&L in 2027.
So essentially, you short the near-term pain and go long the 2027 operational leverage and commodity relief, trading the difference between today's weakness and the strength they're building for 3 years from now. So to recap our deep dive, Mondelez navigated peak cocoa costs. They got a small EPS beat, but they really paid the price on margins and volume.
And that led to a guidance cut that they really had no choice but to make. The company's entire focus is now on 2026.
And their ability to deliver really hinges on one thing.
It does. It's whether that recovery driven by cocoa deflation funding a big advertising push can actually overcome the consumer pushing back on price in the US and Europe. Their playbook is clear. Shrinkflation and ads, not discounts.
So what does this all mean for you? Here's a provocative thought to chew on. Management specifically mentioned optimizing their direct store delivery system. This is the expensive system that makes sure Oreos are always perfectly placed on the shelf.
They're talking about using fewer distribution centers and branches starting in 2027 to save money.
Right. So the question is, what are the long-term competitive implications of that? If they centralize their logistics to save a few points on margin, do they risk losing that service advantage that DSD gives them? Could it hurt their relationships with retailers and open the door for smaller, nimbler competitors?
That is some food for thought. That trade-off between efficiency and competitive advantage is something we will be watching very closely. And please remember, everything we discussed here is based on public information and is not personalized investment advice.
We absolutely encourage you to review the full details and form your own conclusions. Thanks for diving deep with us. We'll catch you next time.